Hi, and welcome. My name is Casey Boland. I'm a wealth advisor and partner here with HCM Wealth Advisors. I'm joined today with Doug Johnson, who's our Senior Investment Strategist and partner with HCM Wealth Advisors. Welcome to our webinar. If you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have the opportunity to submit your question. We'll do our best to answer at the end of our webinar, maybe even during the webinar at times. Doug, a lot has happened since our last webinar, which was shortly right after Russia invaded Ukraine. Unfortunately, that war has continued on. Since then, we've seen the Fed increase interest rates, and we've had a lot of market movement, market going down, market actually going up some. So we're going to work out some of those issues today during the course of this webinar. But first, we're going to take a quick few minutes. We're going to touch on taxes. So this is just a brief reminder of actions that can still be taken for 2021. And before we do that, the majority of our tax planning really is done throughout the year. It could be reviewing your income needs in retirement and mapping out the most effective way to optimize income realization within tax brackets. Not only just for this year, but it's mapping out a strategy for several years, given the changes in your life and potential changes to the tax code. Anything, it can be deferred compensation decisions, retirement contribution elections, to looking for harvesting opportunities to reduce taxes on capital gains. It might be charitable gifting strategies that also provide maximum tax benefits. And it could be unique items like net unrealized appreciation planning that comes with specific company stocks. So the list goes on, but back to our reminders. So let's take a look at this. So a couple things. If we look at IRA and Roth IRA contribution limits, they are $6,000 for last year and $7,000 if you're age 50 or older. Now, Roth, it's not going to save you some dollars, but still, it's a great tax-free account to take advantage of. And health savings accounts, these are fantastic accounts because you get a tax deduction for contributing to funds. It grows tax-free, and when you withdraw it and use the funds, it's tax-free as long as it's used for qualified healthcare related expenses. And you can harness the stock market with a lot of these plans and being able to invest those funds. You get a catch up of $1,000 for those who are age 55 or older. And as you can see individually, you can put $3,600 in and $7,000 as a family. And then lastly, with SEP IRAs, they can be established actually opening the accounts and funding them all the way up until your tax filing deadline. And you can put in 25% of your net earnings. Again, that's up to $58,000 for 2021. Now, before we move on to taxes, I've got a savings hack here for you to consider now if you contribute to IRAs or Roth IRA accounts during the course of the year. Now, most people, when they make their IRA contributions, they tend to wait. On average, about 40% of the dollars are contributed to IRAs for any given tax year that happens between January and April of the following year. And only 10% of investors contribute in January, which is the first possible month of a tax year for those IRAs. So why not put your money into the IRA earlier and get that money working right away for you? Well, for some, they may be waiting to see if they qualify for a tax deduction or if they can even put money away in a Roth IRA. But for most people, I think the idea is probably a little bit different. Probably procrastination, I think, sets in for most. And then it means that they're investing and putting the funds in later. So let's take two investors. I'm going to give you a reason of why to consider putting that money in earlier. So if we've got two folks, they both make maximum contributions to their IRAs, which is $6,000 a year. Both make contributions for 31 years. The difference, one of the investors is going to start making their contribution in January, while the other waits up until April 15th of the following year to make their contribution for the prior tax year. Now, assuming the money grows at 7% per year, the saver who makes the full contribution in January, get this, would have more than $50,000 in additional savings, even though both contributed equal amounts overall. Now, I can think of many different ways, Doug, to handle an extra $50,000. And hopefully this can help you or maybe a family member. So, all right, let's shift gears. Let's get to the market and let's talk about some of the different implications of, unfortunately, with what's happened now with this war with Russia and Ukraine. We've already talked in recent months about inflation pressures. And as we've heard and seen, commodity prices have skyrocketed. So as you can tell on this slide, boy, look at Russia and Ukraine, the accountability that they have and how they're tied to so many of these different commodities. 30% of global wheat exports come from those two countries. Russia is a major source of soil nutrients for fertilizer. So that's had a big impact on fertilizer prices. So Russia supplies about 10% of the world's nickel. And on March 8th, there was this goofy event where nickel prices more than doubled to over $100,000 a ton. There was a Chinese producer that was forced to buy large amounts to cover short positions, and it prompted the London Metal Exchange to halt trading. And you've got aluminum. Russia supplies almost 6% of the world's aluminum supply, and Australia decided to ban exports to Russia. They're a big part of producing that metal. And you can see it's impacted many other commodities as well. So speaking of commodities, I'm sure we've all felt it when you look at the gas pump. Boy, oil prices skyrocketed in the course of the recent weeks, surging above $125 a barrel for crude. It's recently resided right around $112 a barrel. So I'm sure we felt that all. And at some point in time, that takes time and certainly can have an impact on the economy. So we look at drilling. So when we look at what's happened with oil prices and you look at drilling, energy stocks now, those stocks have reaped the benefit of these higher prices. But as you can see on this chart, the number of drilling rigs is quite low. Some companies have predicted it's going to take 6 to 12 months to get a lot of these additional rigs online to help with the supply issue. And the energy sector has been hit hard in the last 7 to 10 years, which resulted in substantially less manpower and infrastructure available to produce gas and oil. Doug, so we've seen what's happened in the course of inflation, what it's done to commodity prices. I mentioned stocks earlier. What's been the impact from the stock standpoint?
Well, I think there was a lot of concern that the war was going to have a material impact on the market. There was some volatility, but if we look, here are the returns for both the S&P and for international stocks from the day of the invasion, which was February 24th. So, not to sound crass, but you almost want to say, what war? Because it's really had no effect. I mean, yes, there was an initial decline in equity prices, more affecting the international markets, but you actually have both markets up since the beginning of that conflict. Now, obviously talks about potential ceasefire, things being priced in, the worst scenarios, already taken off the table. But I think there remains a lot of uncertainty around the situation. And as you touched on the commodity space, I think that is the one that's going to be the most impactful, down the road, because, commodities are supply and demand equations. And when you do not have additional supply coming online and you don't see a meaningful demand decline, you're going to continue to get prices to move up. So, we talk about inflation a lot, and we've looked at a lot of inflation charts, but now we're really coming into the time where everybody is paying attention to what inflation is doing and how it's affecting not only the economy and the consumer, but then how it's flowing to the market. I think everyone pays attention to the equity market, but we're also going to talk about what the fixed income market might be telling us in terms of what the Fed is doing. So again, not a surprise. We've gone over this before, but you can see the huge spike in year-over-year inflation here. And we're running at the highest level that we've been at since 1981. So it's 40 years time since we've seen inflation at these elevated levels. Now, the Fed explicitly has two mandates. One of those is price stability, meaning combating inflation or keeping it at a level that they deem neutral or sufficient. And right now that target is right around 2%, and to keep full employment. And I think we can take the employment situation off the table for now, because by every metric that they would pay attention to, employment is doing fine. But here's some of the commentary that came out from various Fed speakers over the past week. So the first one you have Jerome Powell at the press conference when they actually raised rates 25 basis points. So his quote, balance sheet reduction could come at our next meeting in May. The framework is going to look very similar, but it will be faster than the last time, and it's much sooner in the cycle than last time. Okay, so that's seemingly talking about reducing their $9 trillion balance sheet, taking liquidity out of the system, trying to put the brakes on things a little bit. Then 2 days later, you had Fed board member Christopher Waller. Economic data was basically screaming at us to raise by 0.5 point at last week's meeting. Okay. 3 days after that, Powell suggested the Fed would raise rates faster than expected and high enough to restrain growth if necessary to slow rampaging inflation. And then finally, that same day, you have Fed President Bostic, controlling inflation is the top concern I have for 2022. Now, if these were politicians, we would think that they are running on a campaign of attacking inflation full go. So let's see what actually took place. Now, Casey, we looked at this chart earlier, so you know what I'm about to say, but if you didn't point out on this chart what happened, you wouldn't even be able to see it. So here's this tiny 25 basis point rate hike against this massive level of inflation that we're seeing. So if you follow this red line, we can take it all the way back to the beginning of this chart, which is right around 1970. You can see that this red line follows this blue line, which is the Fed funds rate, pretty closely. Yes, there are some gaps here and there, but for the most part, the Fed has done a good job pre-Great Financial Crisis, keeping up with that inflation and really kind of walking the walk in terms of lowering it when needed. Now, the other thing that was mentioned also was reduction in balance sheet. And this has been discussed, ending quantitative easing, because in the same token, they say, we're not worried about recession. The economy's doing really well. And we're gonna slow things down. So you've got a Fed that is talking about being extremely hawkish on inflation. Yet the week that they're making all of these comments, you have the Fed's balance sheet expanding by another $40 billion. So this is clearly a case right now of actions not necessarily matching up with words. And we're going to see how the different markets are interpreting this and what that might mean for assets going forward. So what's the bond market's reaction? Well, you can see that this goes back about to 2021, and it shows the 10-year yield in blue, the 2-year yield in gray, and then the yield curve here in black. So the original Powell press conference back in January, when they first started to kind of offer up the idea that they were really going to be tough on inflation, you started to see yields slowly move up, much more in the 2-year side, as that relates much more to what the Fed can control, as opposed to the 10-year, which is more linked towards economic growth. And we'll get into that in a little bit more detail in a minute. But you see the yield curve slowly start to move lower and lower and lower and lower. You have Boland, who is another Fed speaker. He called for a 100 basis point rate hike back in February, which I think caught a lot of people off guard. And then finally, you have this 25 basis point rate hike. And we see that bond yields have moved up fairly quickly from that point. Now, it's also important to remember, bond yields moving higher, bond prices going lower. So it has certainly been a challenge on the fixed income side, as it has been on the equity side, with the market kind of grappling with the idea of what the Fed may or may not do in terms of actually raising interest rates. And this move in the 10-year that we've seen, and this, this chart is, I don't want to say it's dated, but it's a little bit older. The 10-year number is closer to 235, 240 as we speak right now. So this has even moved up higher. So this move, both in the 2 and the 10-year, has been very extreme. And I always joke about the term priced in because I think it's silly. When you're seeing bond markets move with this much force and velocity, clearly it's not priced in, because if it was, we wouldn't be seeing these type of moves. But more importantly now, this is basically the yield curve 1 year out, right? So the bond market can price in or has pricing mechanisms in the future a little bit differently than the equity markets. So what you're seeing here is the bond market pricing in a yield curve inversion next year. Okay. Now, going back, historically, yield curve inversions have preceded recessions quite often. So the confusing part for a lot of people is here, we have this massive inflation number, and it's historically been tough for fixed income because rates move higher to reflect that inflation. How is it that we can have a yield curve inversion 1 year away from what we're seeing is inflation that's 40 years high? Okay, so hold that thought a little bit, because the equity market may give a little bit of glimpse on why that might be taking place. So while the bond market is certainly taking this seriously, what is the equity market saying here? And we'll get to that in just a second. So I want to show another version. So the 2-year yield move here in purple is just absolutely extraordinary. And again, 2-year yields are much more correlated to what is expected out of the Fed. So if anything's being priced in right now, it's that this 2-year yield number is eventually going to match up with what the Fed funds rate is. Okay. As a reminder, the Fed funds rate is 25 basis points. Okay. They're talking about doing 50 basis points. They're talking about 7-8 rate hikes. They're walking through all these scenarios. So the 2-year Treasury market is saying, okay, we think that you'll probably get to 2%. Then we talked about that yield curve inversion, right? So if this stays here at 2% and we get an inverted yield curve, this orange number has to come down, right? And we've gotten a lot of questions, a lot of trepidation about owning fixed income in this type of environment. And we certainly understand that. But as we move forward and we start to see growth forecasts reduced, we think that this number in terms of 10-year yield is going to start to flatten out and to possibly move low. And if that does happen, then those core bond positions that have bled value throughout the first few months of the year will start to increase in price again, and in our opinion, normalize a little bit. So, I know we've gotten a lot of questions in client meetings about, why do we still own core bonds? We think now is not the right time to adjust those positions because we think those yields are going to come down or flatten out over the next few months. Now, as I was saying earlier, here's the bond market's reaction to this. What is the equity market's reaction to all this? Well, I'm still one slide too fast. I apologize. So one last point in the 10-year. We look at this trend line that we've seen going back all the way to the mid-1980s. Obviously, 10-year yields have been downward sloping for a while. But what you'll notice is that every time the 10-year yield has hit this trend line, you've had some kind of issue come up in terms of the equity market. So back in 1987, you had Black Monday. In 94, you had the tequila crisis with the Mexican peso. 2000, you have the dot-com bust. 2007, you have Bear Stearns and Lehman. 2018, you have this Volmageddon crisis, and really the end of the rate hike cycle, the last one we saw. And now we are butting up and we're through this trend line again. So is this going to mean another crisis situation? Not saying that for sure, but historically, when we've reached these levels, yields have started to come down and we've run into some kind of issue as the market just cannot, and the economy for that matter, just cannot handle that level of yield at that time. So now, I'm pretty sure this is the next slide, but what are the equity markets saying about all of this? They simply do not believe the Fed at all. And to show you what I mean, These are the market returns since the beginning of Jerome Powell's press conference, right? So you have the NASDAQ up 11%, right? So again, the high growth names that are supposedly the most sensitive to increasing rates and inflation are up 11% since then. And then you basically have every other market up 5 to 7.5%. So this is the market almost spitting in the face of the Fed saying, you guys think you're going to raise rates 7 to 8 times? No way. And you think you're telling us you're going to do 50 basis points? You tell us you're serious about dealing with inflation? No, we don't buy it at all. We think that you're going to do what you've done the past 13 years, which is raise a little bit and then find a way to reverse all this and add more stimulus, and then off we go. So two very different views of what's going on right now. And again, this is also coming off of levels that were extremely oversold. So we were certainly due for some kind of bounce. But at the same time, what we saw in this rally was a few breadth thrusts. And what is a breadth thrust? It's just when you have an extreme number of stocks advancing rather than declining over a short period of time. And there's many different versions, definitions, variations of what these are. But the reality is that most of these signal the market is changing its recent pattern and potentially beginning a new bull market. Now, it seems crazy to even suggest that in light of all of the things and problems that we have going on. But several versions of these were actually fired during this rally last week. And while they don't have perfect track records, the historical returns following these events is very strong. And it's certainly something that got our attention and said, okay, maybe the market is interpreting this in a way that we haven't considered before. Or maybe we really need to be paying attention to this. And there was always a possibility that you were going to see some type of reversal because the other thing is we got a lot of questions from clients about positioning in the tactical portfolio, saying you guys sound a little bit worried. Why haven't you reduced risk further? Well, part of it is our opinion, but also part of it is what the market's telling us was going on. And for all of the bad things that we had, the market was telling us that things were maybe not as bad as the news was laying it out. So we kind of straddled that position. And as we're looking at possibilities of adding money back to equities at some point, this is something that's certainly got our attention, and we're going to continue to follow very closely. And then Casey, I know you've had a lot of conversations, not only in the past year, but probably over the last 5 years about valuations, and that being one of the biggest concerns for clients, so to speak.
Definitely. I mean, stock prices being too elevated, are we getting near bubble territories? And certainly stock prices did get elevated relevant compared to earnings, but they got a little bit inflated. This chart is a little skewed just because of what happened during the course of COVID, as you had prices drop, but then you had earnings drop very quickly for a short period of time. But then prices then continued to go up, but earnings went up much faster as things came online much faster. So when you have prices moving up, but earnings moving up even at a faster pace, it's that ratio, that numerator versus denominator of price versus earnings. And earnings last year were a blowout year for companies, so which brought those PE levels down. And you look at from a long-term trend perspective, they're now at more respectable levels. Now looking at a trailing PE of right around 20, and that's kind of more in line with the longer term trend. So valuations are reasonable. I think a lot of people still have questions about what's to hold in the future. And certainly we have an eye on that and what's going to be the impact with inflation. Does that start to nip into corporate earnings and slow down growth? Those are questions to be determined, but very much which we're watching as well, because certainly that could change this number and it certainly could change us in the coming quarters. So one thing we've talked about, Doug and I have done some presentations before on different biases, and one has to do with anchoring. And you can see the definition here of anchoring bias occurs when people rely too much on pre-existing information or the first information they find when making decisions. So another way to think about anchoring, retail industry knows anchoring very, very well. So for example, if a person goes to a shopping mall and they see that the price of a particular product is $100, but hey, it's on sale for a 50% discount and they can have it for $50, they may be more inclined to buy the product. This is because now you've got that discount. It appears cheaper, increases the value of the deal in the mind of the buyer. But on the other hand, if the seller directly offered the product at a $50 price, well, then the buyer might find the price is just too expensive. Now, in the investing sense, anchoring bias causes investors to look at the past investment performance of a stock or the market and assume that's going to continue to remain so in the future. So when you take a look at this chart, you can see a stretch where this stock price was on the rise and then starts to fall off in early 2017. Now, not only can investors, they anchor sometimes to prices, but sometimes they anchor to specific company names that they feel strongly about. So what's the company on this chart, Doug? GE. So GE for a long time had been a strong company. So with GE, anchoring can cause someone to feel the company is worth the price at its high, ignoring changes in the fundamentals. And unfortunately, in this case, this played out very badly in the case with GE.
Yeah. So what are some of the anchoring, biases we may be seeing in the market today? So I think there's a lot that's going on right now, and there's a few that I think are more important than others. But let's just run through these real quickly. So one that I think is playing out as we speak is growth stocks should be worth what they were 5 months ago. So Casey, as you mentioned, with a lot of investors with GE, they would anchor to that high price and assume that price was correct or fair value or whatever you want to call it. And as we've seen, a majority of the kind of low quality, high growth names be hit very hard over the past few months. I continue to hear forecasts and expectations that, this is the perfect time to buy the dip. Because these stocks are just going to go back to all-time highs, giving really no consideration to the fact that we're supposedly entering a period of high inflation, which has historically not been good for these type of names. Bond yields have to go higher because of inflation, or they've been low for so long. So we talked a little bit about balance sheet reduction, quantitative tightening. So if you look at the periods that we've actually tried to do quantitative tightening, which hasn't been many, yields have actually gone down, which seems kind of somewhat counterintuitive because you think if the Fed's taking all these bonds that are on their balance sheet and selling them, that addition of supply is not going to be good. But it's actually been the opposite. And then on the flip side, bond yields won't go higher because they've been low for so long. A lot of people have only seen bond yields at extremely low levels for their entire investing lifetime, or moving lower, and they haven't seen really a significant spike higher in yields. International stocks won't outperform U.S. stocks. This is something we've been talking about forever. But if you just looked at the past 10 to 15 years, you would think, well, why would we ever own international stocks? Well, before then, there were cycles going back 50 years where these two things would trade off and on. And as we look going forward, if we continue to have this inflationary pressure, and the war situation in Ukraine obviously has weighed on the international market, but international and specifically emerging market stocks are really, really cheap right now. And at some point, that relationship is going to switch, and I think it could be right around the corner. Now, if I could highlight one, underline it, star it, this would be the one. All right. Stocks won't go through a long bear market because the Fed won't allow right? So if you think about that statement, there's a group of investors who are maybe 40 years old and under who have never experienced any type of sustained downtrend in markets. Because ever since 2009, whenever there's been any kind of decline, the Fed has stepped in and done something to quote unquote solve that issue. The issue now is that they don't really have the runway to step in and save the day when inflation is 8%. It's only been 0, 1, 2% in the past. So they've been afforded that flexibility, but now they're really in a bind in order to say, okay, we have to prove to everybody that we are serious about fighting inflation. And there's a lot of people right now that are laughing, saying they don't care about inflation. They're going to tell you till the cows come home how concerned they are about it, but they're really not. They're more concerned about making sure that the market has stability, not only the equity market, but the credit market as well. So this is one that I think has really fueled a lot of this buy the dip, or stocks go up in any type of environment mindset that I don't know if I'd call it dangerous, because I think that's a little bit too extreme. But I think as we go through this, it's certainly going to exacerbate any volatility we might see as people's kind of risk compass, I think, is maybe a little off. And then another one, so stocks can't go higher because of inflation, government debt levels, low economic growth, supply changes. I mean, for all the conversations we've had about bonds, we've had conversations with clients who said, I'm worried about all of these things and, want to take some money, sit it on the sideline until this stuff blows over. Well, the thing that we just talked about, the Fed has done an extremely good job of kind of changing investor sentiment and leading to a very different attitude when it comes to markets that are maybe going through volatile periods. Casey mentioned nickel earlier. So if anybody's followed the situation in that market, the kind of Chinese tycoon that they mentioned, he had a trade that went against him in a big way, in a multi-billion-dollar way. I think JP Morgan was also involved in this. And what happened was the exchange basically stepped in and said, we're going to erase all these trades because we don't want this guy losing all this money, which when you think about it is kind of an outlandish way to deal with things, but that's kind of the way that we've shifted in terms of dealing with some of these extreme situations in markets. We've somewhat opened Pandora's box of being able to quote unquote fix things with government intervention. And I think that attitude is maybe permeated throughout the market a little bit. So that's certainly something that I think is resonating in a lot of investors' minds right now. So, another aspect of anchoring or even kind of a recency bias is, we've seen a lot of things, a lot of reports, a lot of statistics recently about market drawdowns and then counter rallies and what that looks like a year ahead of time. And I think a lot of times these type of, I guess, reports can be somewhat misleading because if you exclude a time frame that really didn't work well for a certain strategy and just pull it out, well, you're going to make things look pretty good. So here's a pretty stark example of what I'm talking about. So we've just seen a big rally in the NASDAQ, right? So a rate of change greater than 10% over a 5-day period, right? So in the past 20 years, that's only happened 12 times. And it also has to happen when the index is trading under the 200-day moving average. So right now, I believe the NASDAQ still is at the time when all these observations were done. And certainly at the time at the beginning of this 5-day rally, we were under the 200-day moving average. So if you look at the returns over these cycles, 1 month, 3 months, 6 months, 1 year out, these are incredible returns. So when we talk about breadth trusts and having those grab investors' attention. These are the type of return numbers you're seeing after these occurrences take place. Now, this only goes back 20 years. And for those of you who know your market history, 21 years ago was the very end of the tech bubble. Now, let's take this back further. So now we're taking this back to 1986, okay? So now we have 43 observations, so bigger sample size, probably a little bit more validity to this. So again, same thing, back testing the NASDAQ 100 with a 5-day rate of change greater than 10% when this happens under the 200-day moving average. The numbers completely change across the board, 1 year out, six months out, big time negative returns. So the point of all this is we're not saying that we're entering a huge bear market here, and we're not saying that we're entering a huge bull market. But as we see all these statistics kind of come at us, it's important to try to think about what environment we are going to be in and make sure that that specific time frame is studied and included in anything we're going to try to set up in terms of trading rules or heuristics. Because again, if you only take 20 years, that looks really good. If you take more than 20 years and you get that whole data set in, it doesn't look as good. So, Casey, we've brought this NASDAQ, index up a lot. And again, as I show this chart, I certainly don't want to imply to anybody that we believe that this is going to happen. But as we hear about rallies and counter rallies and things like that, it's important to remember that these types of swings can happen in these kind of long, drawn out markets. And you see the NASDAQ here, peak to trough, 80% decline. That's a huge number. But within there was 5 rallies greater than 25%. So you had a 42% rally, 28, 41, and a 51. So I'm sorry, there's 4, right? So those are big, big numbers, but they're also happening in the context of a much larger decline. So is this a rally that we can believe in, or is this a trap door that is going to spring on us and lead to more volatility down the road? And I think the best answer is we're not 100% sure yet, and it's definitely going to be a process as we go through this and as the market tries to sort through all of these signals that are coming through. So we've laid out kind of points for both sides. Casey, why don't you go through what the bull case would be for this rally to continue and for the market to regain all-time highs?
Okay, Doug, I'll be the optimistic one here. So the market is priced in rate hikes, and this is what's challenging is we look at what's happened in the course of the last 5-6 weeks since this war began, and whether it's anchoring, whether it's recency bias, when the market was going down, certainly I think people were concerned that that trend was going to continue based upon what was happening in recent events. And yet now the market has rallied up in the last couple of weeks. And a lot of it is these rate hikes, they're baked in. The Fed cares more about the market than it does inflation. I don't know if everybody believes that, but I think there is some thought that the Fed realizes that the stock market is an element of confidence. And because of that confidence standpoint, I think there's some thought that the stock market has the potential to be the driver of a recession or major market meltdown. And so because of that, the Fed has to look to be a little bit more of a backstop of that. So, you've seen now only 25 basis points. You had larger sell-offs that occurred in 2000, 2008. At this stage, based upon the Fed actions in the last 2 decades or a decade and a half, it seems like they've made so many adjustments and things to try to prop up the market that it is hard to believe that the Fed would allow the market really to go into a huge meltdown or a massive recession. And we saw that during the course of COVID between the Federal Reserve as well as government actions that occurred of what they were looking to do and what they were willing to do to stave off a recession. the amount of stimulus and the amount of action that was taken certainly made what occurred during the financial crisis, it dwarfed that. So we've seen from the government that they're willing to take action. The breadth thrust that Doug had mentioned earlier certainly may have confirmed the worst is over. We don't know yet. And this is one of these things where I think it's still going to take several weeks, several months to work itself out. But from a bull case, oftentimes the start of it occurs with some of these breadth thrusts, and that's what you can build upon. So if this continues, that's oftentimes been a trigger as one of the starting points. Valuations certainly have certainly improved and come down, look more attractive. And from a bond standpoint, bonds have been a tough place to be this year. Cash doesn't pay you anything. So in some cases, stocks are the only place to be to put money. Corporations are in fantastic shape from a cash standpoint. They've been aggressive buyers of their own stocks. I will say this, history has not always been good to companies when they get in this aggressive mode. Oftentimes they're buyers at high points. We'll see how that plays out. And when stocks go on sale, corporations aren't buying their stocks when that's exactly what consumers should be doing. Corporations aren't doing it, but I get it. They're in a better position cash-wise. They've been aggressively buying stocks. They've been aggressively buying stocks for a while. And I think you can also look to the consumer. Consumer has been in a very good spot from a balance sheet perspective and continues to be buying and purchasing. So from that standpoint, that's the reason why I think this market and economy have been more resilient because of the positioning of the consumer and the corporation at this point.
Great. So on the other side of that, what could continue the volatility that we've seen and maybe be more of a bear case? So obviously, if the situation in Ukraine continues, it's going to put further pressure on commodity prices in the supply chain. And quite frankly, even if there is a ceasefire, that doesn't necessarily mean that the U.S. is going to turn around and just lift all of these sanctions that they've imposed on the Russians. So, the supply chain issue, at least as it relates to commodities, could continue for the foreseeable future. So if the Fed is serious about fighting inflation, and the market is completely ignoring that warning, that could be quite a wake-up call down the road. Quantitative tightening and higher rates will slow economic activity or economic growth significantly. We've already talked about the recession risk, and bond markets are essentially pricing in a recession for 2023, or at least very slow growth. And then finally, inflation will remain high. And just as Casey mentioned, the consumer will hamper their ability to spend a little bit, while at the same time shrinking corporate profit margins and ultimately lowering earnings. So we've gone through the bull case, we've gone through the bear case. I think probably everyone's wanting to know what's the HCM case. So here are some observations that we've had, and then maybe a little bit on kind of how we're viewing this and what our positioning looks like. So the first thing I'll say, the Fed's bark seems much louder than its bite so far. So 25 basis points in the face of 8% inflation is nothing. It's almost a token, especially when you're continuing to do QE in the same week. Those two things almost don't even make sense. But you have seen a little bit stronger language from several Fed officials saying, if we need to do 50 basis points in a meeting, we're going to do 50 basis points in a meeting. Now, they haven't raised 50 basis points since May of 2000. So it's been 20 years since that happened. And they don't have another official meeting until May. So, you could be looking at another 2 months before you see an additional rate hike. And a lot of people are making the argument that if they were truly concerned about this, they would have, you could see an emergency rate hike or an off-meeting rate hike. You'd see plans for the balance sheet changing. So far, I think they're trying to jawbone a little bit more than maybe really getting out ahead of this. And I think the recent rally in the face of all that hawkish language by the Fed maybe confirms for now that the market doesn't necessarily believe the Fed's going to tighten. Either they're not going to try, or they're going to try. They're not going to get to 2%. They're going to get to 1%. Growth's going to slow so much that they're just going to have to turn around, cut rates again, and QE5 or whatever program we're on is just going to turn around and start up again. And the bond market's telling you the recession's coming, while the equity market is basically telling you, again, for now, it doesn't matter because it's just going to lead to more stimulus down the road. And that kind of fits in with this, bad news is good, good news is better, kind of bizarro world that we've seen since we've had all this stimulus. So what I will say is that if the forecasts deteriorate moving forward, but we can avoid recession, I think it could signal an opportunity for us to reallocate some money to the high growth area. Remember, growth stocks are what you'd want to own in an environment that maybe doesn't have strong economic growth, because those are the companies that can provide earnings growth in any type of environment. But if it's a recessionary environment, the staples and defensive names on the value side are still going to be the ones to own. So that's yet to be seen, but we've certainly taken a stance recently that we like value over growth, but if we can, if we see deterioration going forward, we may look to adjust that a little bit. And then with the bond market pricing in a curve inversion in 2023, we expect that rise in yields to begin to slow and possibly reverse course. So we're optimistic that the bleeding on the bond side is going to stop, maybe even reverse itself here over the next few months. So I guess leads us to what exactly are we going to do now with all that information? So from our perspective, we remain positioned for a high inflation regime with Fed tightening and the possibility of a recession. We want to be vigilant of the current or additional breadth thrust signaling a possible turning point, which would mean taking that defensive or underweight equity position back to neutral. And then we're going to continue to diversify across fixed income, including things like cash, global macro strategies, and then also core bonds. And then finally, we talked a lot about the anchoring bias. We need to keep an open mind here. As much as we think that things are going to happen a certain way, if the market tells us a different story, then we have to be willing to be flexible with that. And for now, I think a lot of people are kind of scratching their head with the reaction the equity market has gone through in the face of some really hawkish inflation data and a liquidity environment that we probably have not seen for a very, very long time. And then lastly, famous Mark Twain quote: it ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. So again, kind of having that blind conviction on anything is never a good idea. And I think there's certainly enough uncertainty at this point that we've had in a long time that all investors need to be willing to have an open mind and interpret that data as it comes through.
And Doug,
So
I think you hit on a big component of it. It's just the uncertainty component, because this can play out so many different ways. And, one of the things that certainly can be the killer to inflation is a recession or slowing growth. And certainly the Fed is going to try to thread the needle to get slowing growth. They realize growth is going to slow on some level anyway, because of the impact on what we're seeing with commodity prices, and that's going to have an impact. But their hope is that by raising rates and giving themselves time, as you've mentioned in the past, I think their hope is that some of these supply chains will start to work themselves out. If this ends up being a short-lived war, then certainly more supply chains be able to come online and improve, and it buys the Fed more time as they're making these rate adjustments that might help things out, and they start to see core inflation actually start to come down later in the course of the year, beginning of next year. Now, they've been wishing for that for quite a while now, and we'll have to see how that plays out. But the Fed, again, if they do things and push things too far, they may be able to deal with inflation, but it hurts growth too much. But at the same time, they may be willing to then turn around with other programs to try to get the markets back going again. Again, this could go several different ways over time. And just as we've seen in 5 weeks, a big downturn to a big upturn, we're likely to continue to see some volatility here in the coming quarters.
Yeah. So I think we're right at time here. I know we have a few questions, and We will reach out to those clients in the next day or two and address those directly. So I want to make sure that everyone knows that we will get those questions answered. But Casey, I think that's it for now. If you want to go ahead and take us out.
Yeah, it's thank you again for attending our webinar, and we appreciate the confidence and the trust that you've placed in HCM, and certainly that's something we do not take lightly and understand the task at hand. So thank you very much for that. And if there are friends or family that we can help out, please reach out to us, and we're glad to get in contact. Thank you and have a great night.